Hey everyone, welcome back to Corporate Decoder, the place where we make financial filings speak. And today we're diving deep into the Nomura Value Fund's latest shareholder report. It looks like they've had a pretty interesting year, and we're going to break down what all those numbers really mean for a typical investor. Before we dive in, if you love getting the real story behind these corporate documents, hit that subscribe button and the notification bell. And hey, we've got a fantastic community over on Discord discussing all these filings. The link is in the description below. This report covers the period up to the 30th of November, 2025, and it lays out how the fund performed, what it holds, and some key changes that happened behind the scenes. Now, let's get straight to the juiciest part, the money. Imagine you invested $10,000 in this fund. For class of shares, you'd be looking at costs around $96 for the year, which is about 0.95% of your investment. That might sound small, but remember these costs can add up over time. For class C shares, it is higher, about $171 or 1.70%, and for the institutional class, it is a much lower $71 or 0.70%. This clearly shows how much more expensive it can be to hold certain share classes, especially if you do not qualify for institutional pricing. Now, about the fund's performance. For the year ending the 30th of November 2025, the Nomura Value Fund class of shares returned a modest 1.59%, excluding any sales charges. That is quite a bit less than the broad market index, the Russell 1000 index, which jumped 14.09%, even the benchmark. The Russell 1000 Value Index did better at 7.25%, so the fund really lagged behind its benchmarks this past year. The report mentions that holdings in communication services, specifically interactive media and services, were good contributors. They also benefited from positive stock selection in the materials sector, especially specialty chemicals, and an underweight in the energy sector. Plus, an overweight in information technology helped too. But on the flip side, stock selection was a major drag. The fund's holdings in consumer staples, like food products and personal care, underperformed. Financial sector stocks, particularly in payment processing and regional banks, also dragged down performance. Even in information technology, where they were overweight, stock selection was weaker. With semiconductor and electronic equipment companies lagging. Looking at the fund's size, its total net assets are a hefty $2,006,274,445. That is a lot of money being managed. Let's see where this money is invested. The biggest chunk, 21.74%, is in financials. Then comes healthcare at 16.33%, and information technology at 13.72%. Industrials make up 13.05%. The rest are smaller allocations. It is interesting to note the heavy weighting in financials and healthcare given the performance detractors mentioned in the report. And who are the big players in their portfolio? At the top is Alphabet Class A, notching 4.74%. Then Thermo Fisher Scientific at 4.16%, Merck & Company at 3.96%, and Bank of America at 3.94%. These are well-known names. But the question is, are they the right names for this fund's strategy and performance goals? There have been some significant changes. The fund was renamed Nomura Value Fund starting the 1st of December 2025, and it used to be called Macquarie Value Fund. This rename likely signals a broader shift in ownership or strategy. Also, a big change in accounting. They switched their independent auditor from PricewaterhouseCoopers to Cohen & Company. This kind of change can sometimes signal a shift in how accounting practices are viewed or enforced. When we look at accounting fees for 2025, the audit fees billed by their new accountants were $130,000, a big jump from $35,000 in 2024, likely due to the change in auditors. Tax fees also saw an increase. Digging into the actual holdings gives us more insight. For example, Alphabet Class A is listed with nearly $95 million worth of shares. Thermo Fisher Scientific is also substantial. This detailed list shows us exactly what the fund is betting on. Looking at the financial highlights for Class A over the years, you can clearly see the ups and downs. For example, the net asset value at the beginning of the period for Class A shares in 2025 was $19.17, but it dropped to $14.82 by the end of the period. That is a significant decrease, showing a value loss for investors. And that is reflected in the total return. For Class A, the total return was 1.59% for the year. However, looking back 5 years, the average annual total return is 7.88%, and over 10 years it is 7.62%. While this is positive, it is important to compare it to the benchmarks we mentioned earlier. The expense ratios are also important. For Class A, it is 0.95%. This might seem okay, but when you compare it to the actual returns, you see how much of that return is eaten up by fees. For instance, last year Class A shares returned a negative 4.25%, including sales charges. The statement of assets and liabilities gives us a snapshot of the fund's financial health. Total assets are over $2 billion, while total liabilities are just about $6.4 million. This means the fund is in a strong position regarding its assets versus its debts. The statement of operations shows us the income and expenses. They earned over $50 million in dividends, but had expenses totaling over $19 million. The net investment income was about $30.5 million. However, the real story in operations comes from realized and unrealized gains and losses. For the year, they had a net realized gain of over $572 million, but a massive net change in unrealized depreciation of over $649 million. This resulted in a net loss for the year from operations of over $45 million. This is a crucial point. A huge unrealized loss wiped out solid realized gains. On a tax basis, undistributed long-term capital gains are over $405 million. This is money that has been earned but not yet distributed to shareholders, and it can have tax implications. There was significant discussion about the investment advisory agreements. The board reviewed the nature, extent, and quality of services, investment performance, comparative expenses, economies of scale, management profitability, and ancillary benefits. They noted that for the year ending the 31st of December 2024, the fund's total return was in the fourth quartile of its peer group and below the median. That is a key indicator that performance has been a challenge. They did find the nature, extent, and quality of services provided by Delaware Management Company, or DMC, and their sub-advisor to be satisfactory, despite performance issues. They also noted the impending acquisition by Nomura Holding America, Inc., which was seen as a potential positive for accessing resources of Nomura's global business. But when it came to investment performance, the report was less rosy. The fund underperformed its benchmark index. The board acknowledged these performance shortfalls and discussed reasons for the underperformance with the management team. On the expense front, the fund's actual management fee was below the median of its peers, and total expenses were also below average. This is good news for investors, as costs are not the primary reason for the underperformance. The board also looked into management profitability and concluded that DMC's profits were not excessive given the services provided. Ultimately, after reviewing all these factors, the board unanimously approved renewing the investment management and sub-advisory agreements for another year. It seems they are betting on the management team to turn performance around, especially with the upcoming integration into Nomura's larger global structure. So, what is my take on this report? The fund's expenses are reasonable and in some cases below average, which is a big plus. However, the investment performance has been lagging significantly behind its benchmarks and peers for a considerable time. The significant unrealized losses in the statement of operations are concerning, suggesting the fund's holdings have decreased substantially in value. Even if some realized gains were achieved, the renaming to Nomura Value Fund and the acquisition by Nomura Holding America Inc. could bring new resources and potentially a new strategic direction, but the underlying performance issues need to be addressed. The heavy allocation to financials and healthcare, coupled with underperformance in those sectors, is a red flag. For investors, the key question is whether the management team can improve performance under the new ownership, or if the fund's strategy itself needs a rethink. It is a situation that warrants close watching. Alright, that is our deep dive into the Nomura Value Fund's annual report. What do you think about their performance and the changes ahead? Let us know in the comments below. If you found this analysis helpful, give us a thumbs up, subscribe for more, and don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.